Retirement planning. When you close your eyes and imagine your retirement, what do you see? You probably imagine retirement as a reward for a lifetime of hard work, full of possibility and potential. You may look forward to pursuing hobbies, traveling, and spending time with grandchildren. Or maybe you see retirement as an opportunity to go back to school or to start a new career or business. There's good reason to see retirement in a positive light. After all, Americans are living longer, healthier lives than ever before. In fact, your retirement may well take up a full third of your life. Of course, that means that your retirement assets will have to do more for you over a longer period of time. This makes planning for retirement essential. To plan for retirement, you'll want to have a good idea of how much annual income you'll need. You may start by targeting a specific percentage of your current income, but you shouldn't stop there. You should carefully consider your current expenses and think about how they might change by the time you reach retirement. Don't forget to consider the potential cost of health care in retirement, including the high cost of long-term care. And as if that weren't enough, you'll need to take inflation into account. Traditionally, retirement income has been described as a three-legged stool comprised of Social Security, employer pension income, and individual savings and investments. Today, fewer employees are covered by traditional employer pensions, and it may not be realistic for you to think about your annual income needs will be met solely by Social Security. That may leave just one leg of the traditional stool for you to rely on, your own personal savings and investments. You might assume that you can hold off saving for retirement and make up the difference later, but this can be a very costly mistake, with personal savings playing such a critical role. It's important to start saving now. If you aren't already doing so, you should consider taking advantage of special tax-deferred retirement savings vehicles like a 401k or a 403b plan and an IRA. What these savings vehicles have in common is that your savings grow tax-deferred until withdrawn. And in the case of Roth accounts, qualified withdrawals are completely free from federal income tax. With all other things being equal, savings that are able to grow tax-deferred or tax-free will outpace savings that are subject to income tax on earnings every year, because funds that aren't used to pay taxes annually keep compounding. But an effective retirement plan involves a lot more than just savings and tax advantage accounts. Choosing an investment mix that will provide you with a potential rate of return that's appropriate for your timeline is also important. In the end, though, the investments you select have to fit your own level of risk tolerance, and you should be conscious of diversifying your investments among investment categories. You'll also need to revisit your plan periodically and make adjustments. In the end, you don't get the retirement that you deserve, you get the retirement that you can afford. So understand your options, ask questions, and start planning now.